Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, real estate, loan, insurance, and everything else about your money. Of course, we also get expert perspective on those about conversations. We'd love to have the show interactive, so please feel free to write in with all your questions and queries on this YouTube Live. I'm Samina Nalwala, and first up, the headlines of the day. Food delivery giant Swiggy to launch its IPO on 6th November. The SoftBank-backed company aims to raise up to 11,300 crore rupees through this offering. The share price will range from rupees 371 to 390. The IPO includes a new issue of shares worth 4,499 crores, and existing shareholders will sell up to 17.5% stake. The company plans to use 1,343 crores from the fresh issue to invest in its subsidiary Scootsie, and 703 crores for technology and cloud infrastructure. Additionally, 1,115 crores will be used for branding, marketing, and business promotion, also covering growth opportunities and general corporate funds. Well, spot gold prices closed to record highs at $2,758 per ounce today, influenced by geopolitical tension and the upcoming US presidential elections. Well, on the auspicious occasion of Dhanteras, which is today, the price of a 24-karat gold has eased slightly to 7,996 per gram, down by rupees 490. Even with this marginal decline, domestic gold prices have risen over 20% this year, reflecting a very strong market sentiment. Silver, on the other hand, is on a breakout with prices nearing a lakh per kilogram in New Delhi. Well, from gold to black gold, oil prices have stabilized after a significant drop of 6% yesterday. This was the biggest decline seen on crude in over 2 years. The market now focusing on the potential for reduced tension in the Middle East and the upcoming US economic inventory report. Brent crude was trading around $72 a barrel, while WTI was just below $68 a barrel. The steep decline on Monday comes at a critical time for oil prices, with US elections approaching in the next few weeks. In other news, there may be a new payment platform coming soon, as Jio Payment Solutions, a fully owned subsidiary of Jio Financial Services, receives approval from the RBI to function as an online payment aggregator. The certificate of authorization, effective from October 20, 2024, will now allow JPSL to handle digital transactions as per Section 7 of the Payment and Settlement Systems Act 2007. There's also another update on Jio BlackRock Asset Management and Jio BlackRock Trustees, two joint ventures between Reliance Jio and BlackRock, were incorporated on the 28th of October after receiving an in-principle approval from the Ministry of Corporate Affairs. In other global news, it's JP Morgan Chase CEO Jamie Dimon who's talking or was talking in an event recently where he raised concerns about the conflicts in Ukraine and the Middle East. He said that the concerns in the US, the concerns are rising on back of stress amongst a number of nations around the world right now. He did say that the risk is extraordinary and World War III seems to have already begun. He added that the battles on the ground are being coordinated in multiple countries. Dimon also warned about how geopolitical threats could hurt the global economy. The JP Morgan Chase CEO also said that risk management teams at his bank have run scenarios that will shock people in terms of the possible economic damage of a global conflict that spirals out of control. Well, those are the top headlines on this Tuesday evening, an auspicious day given it's Dhanteras. So I guess you're running out to go out and celebrate your festivities. But just before we go into that, we have a quick conversation lined up with Vipul Bhowar, Senior Director and Head of Equities at Waterfield Advisors, to understand, one, whether you should rebalance your portfolio in the current market setup, and if yes, how do you go about doing it? Thank you, Vipul, for taking out the time to talk to us this Tuesday evening on Dhanteras. I want to start by asking you, the markets have been so volatile. October has been a very tough month. If you're a bull, you've of course found things difficult. If you're a bear, the upside for you also could have been capped. So it's been a difficult trading market if you're a trader. But 7% down on the Nifty, a little bit of a material recovery yesterday. Keeping both those in mind, Do you feel that the current market environment is conducive for an investor, even if he is aggressive or conservative?
So hi Saminath. Season's greetings to you and your team. Um, so I would start by saying that broadly, markets will go through their cycles, and the whole objective of investing is to look for opportunities where we can maximize our returns. Uh, of course, in the last 4 years, portfolios which were built towards or were tuned towards an aggressive allocation have done extremely well. But if I take a step back and if I look at the previous 4 years, which is 2016 to 2020, conservative strategies have done very well. So to look at that phases, I think it's one should look at um, one should assume that markets are going to be volatile, and portfolios should be built along with their long term objectives, and of course with returns in mind. At the end of the day, portfolio rebalancing is more got to do with what is the rebalancing, what is the return expectation, and what is the time horizon one is looking for.
Vipul, we talk about rebalancing very often, and this is very pertaining to somebody who has an advisor. But what happens to individuals who don't have an advisor and are DIY in that sense, right? So, start by explaining to us what is rebalancing. Should it be done by everybody who's an investor? And is it only for investors? Is it only for traders? Is it for short term investors, medium term investors, long term investors? So break down rather the concept of rebalancing for our viewers.
Sure. Before coming to rebalancing, I would say as a portfolio, diversification is important. What I mean by diversification is that look at various asset classes, and look for allocating or investing in those asset classes. Fortunately, in the last 10 years, most of the asset classes have a financialization way of investing in those asset classes. I mean, 10 years back, we never had REITs to participate into real estate. So the first step is to diversify, and then in that diversification, we need to create an objective as to what can be short term, what can be long term. By short term, I mean any expense or any cash flow requirement for the next 1 year or 2 years. Those asset or those allocations should be parked in a fixed income strategy, whereas something which is required in the next 5 to 10 years can be where equity as an asset class can be considered. REITs in which are considered for short-term cash flows, or anyone who's looking for a quarterly cash flows. So that is the broad diversification. From a rebalancing point of view, let's take an example. There are only two asset classes. Just to make it simple, there is equity, and then there is fixed income, and the portfolio is equally divided into two asset classes: 50% in equity, 50% in fixed income. And let me go back. Let me start with 2020 as a base. In the last 4 years, my equity allocation would have gone from 50, it would have gone towards 65, 70. um, and today, looking at my portfolio, I need to rebalance. I need to bring it back to 50-50. Now generally, it generally is, what happens in that phase is that when one asset class has done very well in the last 4 years, the general perception is that why should we rebalance, and why should we let it be the way it is. I'm okay with today 65 35 kind of allocation. But with that comes inherent risk. So what happens with the market corrects, like what is happening in the last few weeks? Automatically the volatility in the portfolio goes higher. So this is where rebalance merits to it merits to rebalance the portfolio with the context that you can actually shift to other asset class, like gold as an asset class can be considered. But this is where broadly over a period of time, over a period of 4 to 5 years, it certainly merits a rebalancing. Now the question is whether you want to bring it back to 50-50 or make it 60-40. That is something depending on the opportunities available, or depending on the return expectations. But plain vanilla, over a period of time, it certainly merits rebalancing. Lastly, most importantly, every asset class goes through its own cycle. So in the last 4 years, equity as an asset class has done very well. Gold as an asset class has done very well. But if you take a 10-year view, both asset classes have behaved differently. So it merits and also merits rebalancing the portfolio with the underlying asset class also in mind. So that is how one should look at rebalancing, not just plain vanilla percentage terms, but also look at various investment opportunities. At the same time, what is the whether we are okay with the volatility in the portfolio, if the portfolio which is 50% equity goes to 75% or 60% equity.
Vipul, so this is where I sort of get stuck, right? If you do have the appetite to stomach the volatility, because I think that's the key takeaway, right? If you are
Yes.
investing in equities, invest for the long term because the short term journey will be volatile. But of course, once you get to your goalpost, you will be rewarded in some ways for stomaching that volatility. So if you do have the appetite to stay put and stomach the ups and downs, do you still think one needs to rebalance in in market correction phases?
So yes and no. So it depends on. So let me answer it this way. So if my return expectations are met, so if at a overall investment level, if my return expectations are met, and in the last 4 years they would have exceeded my expectations. Whether we should capture that returns and rebalance the portfolio. That is one way to look at rebalancing the portfolio. The other way to answer this question is that whether we should whether we are okay with volatility in the portfolio. Unfortunately, in the last 4 years, we have not seen the volatility or for too long. Even if there's been volatile markets, it's not been a phase or a period of 2 3 quarters where markets have been volatile. It's been a 1 month or 2 month volatility. And probably this is the phase where actually probably this is the first instant in the last 4 years where I see portfolios are now become volatile. So to answer your question, anyone who has a 10-year view, and the portfolio is predominantly equities. By default, it'll be volatile, but from a 10-year point of view, it is safe to assume that the return expectation would be higher. I would say it is an individual call. I would say I've seen portfolios where um, if equity as an asset class has done very well, incremental allocations have gone to equity, and a 50-50 strategy eventually has gone to 75-25. The other way, other change which has happened and which we have seen in the last few years is the taxation on fixed income has gone higher. So predominantly, two things have happened. One, of course, the interest rates have fallen, and hence the returns on fixed income are if I include tax and inflation, there's hardly any returns, and hence by default, it is forcing portfolios to shift to equity as an asset class. Inherently, a 50-50 portfolio today has predominantly moved to 60-40, and the balance 40% fixed income is also moving out into other asset classes, be it gold, be it REITs, InvITs. That too is happening, but this is something which is something which it's a phase, it's a transition which is happening, and whether the volatility is playing out is something I don't have an answer, because the transition from fixed income assets or to other assets is something new. So
Hmm.
someone who is willing to take the volatile, I would certainly say should be should go ahead. But I've yet to see large drawdowns, and hence clients reacting
Right.
to large drawdowns. That's how I would look at it. It's a portfolio driven call.
Okay.
Higher the equity, higher the volatility.
Right. So I think the key takeaway is you should rebalance, and the situations or events under which you need to do it is if there is rebalancing due to market performance, or if there's a change in your objective or your cash flow, I'm assuming, which is a lot more personal in that sense. But
Sure.
let's start by how one does this, right? This is something we talk about often, very great qualitative discussion, but how do you rebalance the portfolio? Do you take off profits off the table on investments that have made money? Do you do this incrementally, or do you do this in one shot? You want to explain this to us, the process
Yeah.
of rebalancing?
Yeah. Let me again take an example. Let's assume 50-50 strategy, 50% equity, 50% fixed income in the last 4 years, and in that equity allocation. it was 50% large cap and 50% allocation was to mid and small cap strategies. So in the last 4 years, mid and small cap have done exceedingly well. And hence what would have happened is, if my equity allocation was 50% equity, 50% small and mid cap, that 50% small and mid cap would have actually gone to 70% or 60% on the higher side. So the first round of rebalancing is actually within the asset class, that we reduce our allocation to mid and small cap and bring that allocation to 50-50, which was the desired allocation strategy. That is the round of rebalancing. How one can go about it? It did not be one shot. It can actually go in tranches. We can slowly, gradually, month by month, quarter on quarter, try to rebalance. Of course, taking taxation into consideration, long term, short term into consideration, and that is how one can plan the rebalancing within the asset class. And then over and above is the overall asset allocation. So overall asset allocation, if that 50% equity has gone to 60, like I said, if you want to bring it back to 50, this is how we would want to go about. First mid and small cap rebalancing, and then overall rebalancing. But it need not be in one shot. It need not be in one shot. We can slowly, gradually, move to other asset classes. Also, the reason why many clients have done, or I've in my experience, I've seen clients doing a one shot, is when there is a incremental opportunity, which is for a short term period. Like if there is an opportunity available to invest in a fixed income asset, or any other asset where the time to invest is limited. It's only in those situations where we have seen clients exiting in one shot, or else the whole rebalancing happens in a phase of 1 or 2 quarters, is where it is recommended to do rebalancing.
Right. Vipul, now, of course, we've talked about how we need to rebalance at an asset level, right? So between equity, debt, and like you mentioned, REITs. That is, of course, the first level of rebalancing. Then comes rebalancing at a product level. I want
Sure.
you to explain to us, how do you rebalance across mutual funds? Do you exit from funds that have outperformed? Do you exit from funds that have underperformed? How do you do that exercise of consolidation? And also, in the same breath, how do you rebalance at an equity level? So, if you're a direct equity portfolio investor or a direct equity investor, should you rebalance as well? Should you average out when price is correct? Is that something you talk about?
Yeah. So predominantly, in when we are designing an equity strategy, it is a mix of direct equity portfolios. It's a mix of mutual funds, and it's also includes portfolio management services. The thought process is simple. Um, Most of the mutual fund strategies, we believe, are skewed towards large cap. One, they are more large cap focused. I would say max flexi cap is the strategy which happens on the mutual fund platform. And within the mutual fund platform, it's one third of the portfolio is towards passive strategies, plain vanilla index funds. That is how the allocation happens. And then there is a basket of flexi cap strategies which is built around those index strategies. In PMSs, the thought process is, if we want to participate in mid and small cap, if you want to have a mid and small cap allocation, the best way to best way to participate in mid cap and small caps today is through professional PMS managers, because we think there is this advantage which those fund managers have. A, the portfolio is concentrated. Second, they can actually take those sector calls, where as a mutual fund I'll have to replicate the benchmark at any given point of time, or be closer to the benchmark. A PMS does not need to do that. It can actually go overweight, underweight, depending on the conviction of the fund manager. And and lastly is the direct equity strategy. The direct equity strategy actually is a summation of what is getting built on the mutual fund platform and on the PMS platform. There are certain themes which the overall PMS and mutual funds are not have not incorporated, or they have a smaller weightage. The direct equity strategy builds to that. So, for example, let me take an example of a sector. For example, within mutual funds and PMS, insurance as a sector is where there is not much of an allocation, and we believe if insurance as a sector is going to do very well, or pharma healthcare is going to do very well, this is where we incrementally add to those individual businesses. To your question on rebalancing, I think what we do is in direct equity. we cap the sector. So we cap the sector. So at any given point of time, we will never have more than 25% to one sector, and within the sector, we'll never have more than 15% to one stock. So that is how the capping is done. And how do we exit? Of course, first round of exiting is underperformers. So at any given point in time, certain strategies over a period of 2 3 years continue to underperform the benchmark. Is something we look to reduce, exit, and rebalance into new strategies or within the existing strategies. Or if the fund manager has changed or the style has changed. So when we allocated capital, the view was that the strategy was skewed towards growth, and then we realized no, the strategy was skewed towards a value style of investing. That is where the exits happen. So performance, of course, one. Second is change in the fund manager, and third, of course, change in strategy. This is how
Right.
the rebalancing or the exits happen.
Right. Vipul, I know you track equities quite closely, and I think everybody wants to know this, right? Everyone is talking about how sectoral rotation is at play. From last summer to this summer, I think the theme for the major part of the year was buy anything that's PSU. We have had the earnings season behind us. There is some disappointment. There are some earnings from broader markets that have impressed, and BFSI has stood out largely in terms of positive surprises. So it's a two-part question. In terms of market cap, first, do you feel like the bias remains towards rebalancing and increasing your weightage towards large cap stocks, or are you using the correction to go back and add the broader market names or sectors, largely because mid cap is technically now gone into a correction phase after a 10% decline from its record highs? Where is the bias?
Yeah.
Would you add more to large cap or would you add more to broader markets because the valuations there are now compelling?
Yeah. So I'll answer the first part on valuation. So one, let me take a step back. So one of the reasons why we saw a broad-based rally in the last 4 years, 3 to 4 years, is because of two fundamental factors which played out, and it played out across market caps. So two things happened post pandemics. Management decided to do two things. One is to reduce the debt, to clean up the balance sheets, and second was that they did no more capex. No capex was announced. In that, in the first part, when the interest cost came down, when I started cleaning up my balance sheet, my interest cost came down, and straight away it my profitability went higher. So that was first reason why earnings expectations or the earnings returns went higher. Second, because there was no capex announced, when the demand came back, all of a sudden there was limited supply because all players did not come back at the same time. Everyone took time to restart their businesses, and hence prices shot up. So in the last 4 years, what we saw was these two factors actually playing out, and which is the reverse of what is happening today. If you look at the first quarter results, the top line growth continues to grow, but the profitability has come down because margins are taking a hit because the prices which went high, now the prices are correcting or consolidating. And this is the phenomena which is going to play out at least for the next 2 3 quarters, because the supply has now come back, and hence to maintain the same kind of growth, either I'll have to increase my I do capex or do marketing or invest into business, or I'll have to reduce the prices to maintain the economy, maintain my profitability. So to that context, the broad based phase of the market is over. I think the rally is now going to be sector specific, and it is going to be businesses where earning visibility is going to be higher. And
Right.
and 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 to answer your question, how should one look at it? Of course, there was this sector rotation which is playing out. I think one the results which are coming in, and companies which are announcing good results are those companies which did capex in 2021 2022, and now that the capex has started, those companies have reported good numbers, whereas companies which are as is wherein basis are seeing a margin correction. So that is what is playing out. So I would say between large cap, mid cap, small cap, I think there are few sectors which continue to do very well, and they will do very well. While the broader market consolidates, certain sectors are showcasing comeback, and within the sectors also is slowly, gradually, individual businesses are trying to show recovery.
Right. Vipul, a quick rapid fire. Now, if you're looking to rebalance your portfolio and making a lump sum exit from underperforming or overperforming assets or products, if you have to reallocate the money, would you recommend doing it through an STP or an SIP in the current scenario?
Yeah, so STP, and it would be in the next 2 quarters.
So you would start allocating, you wouldn't reinvest your profits in lump sum. You would do it over the period of the next 6 months. Is that the
Yes,
right way to look at it?
yes, yes.
Okay. If you had 100 rupees, how much would you give to large cap? How much would you add to broader markets? If
So yeah, so it will be 50% large cap, 30% mid cap, 20% small cap.
right, and in terms of sector preferences, where would your bias sit?
So, healthcare as a sector, I am not, I'm specifically not mentioning pharma. Healthcare would include hospitals, diagnostics, and pharma. So
Yeah,
that is one sector. So in volatile markets, there's always this flight to safety. So I think technology will come back. Technology, surprisingly, mid cap technology companies still continue to report strong numbers.
yeah.
So healthcare and technology are the sectors where we should see earning recovery stronger.
You didn't talk about BFSI or capital market players
So yeah,
because that
okay.
seems
So
to be quite the theme right now, right?
yeah. So I would say when BFSI, how we look at it is that we have divided BFSI into lending and non-lending. If you see in the last 1.5 years, the non-lending side of businesses have done very well. Now, what I mean by non-lending, the lending part are the traditional banks, private banks, PSU banks, all NBFCs put together, which are lending. The non-lending includes capital marketplace, exchanges, wealth management companies, asset management companies, and insurance companies. So our view is that the incremental market cap of financialization or finance as a sector or BF as a sector, the incremental market cap of over the next 10 years is mostly happening will happen on the non-lending side, and this is where we think the earnings trajectory or the asset under management will increase. So between lending and non-lending, the bias is towards non-lending. In BFSI,
Right.
today the pain is it's widely seen the pain with unsecured lending been difficult. The RBI is making regulations which are difficult to lend. I think the credit cost of BFSI would increase. So that is where I think incrementally re-rating of BFSI or banks looks difficult. But the non-lending side of the business, non-lending side of BFSI, should continue to do very well, and that is where I think
Right.
incremental growth is happening.
Right. Very quick, and I said rapid fire, Vipul. One last question. I know, and it's not a cookie cutter approach because everybody's different, everybody's objectives are different. But if one has to undertake the procedure or the process or the exercise of rebalancing on dependent on the market conditions, what percentage of a correction would you think is a good time to start the rebalancing? Right? How shallow or deep does a correction merit rebalancing as an exercise dependent on market conditions?
Okay. So, Zamina, I think first thing I would recommend is don't look at the market to rebalance the portfolio. We have to look at the strategic asset allocation to rebalance the portfolio. But in situations where we are okay with, so for example, in the same example, if the 50% equity allocation has gone to 65 and we were okay with 65% allocation, now that the markets are correcting, we would want to rebalance the portfolio. In that context, it would say immediately rebalance and exit and bring it back to the desired strategy level, and then look for opportunities where we think the incremental returns would happen. Now, be it equity or be it again some other asset class. That is how one should look at it. But if you ask me in percentage terms, I would look at it from a rebalancing point of view first. The second is within the allocation, if the bias is highest towards like in today's scenario, I'm sure most of the portfolios will be overweight mid and small caps. So that is where immediately we can go back and rebalance the portfolio. If the correction is as steep as 10%, which has happened recently, I think it should be an immediate action plan that we should reduce our mid and small cap allocation and then probably rebalance the portfolio.
Right. Well, we're completely out of time, Vipul, but we have a couple of queries. I'll try and take up one at least. Akash Kotian writes in and he asks, how often should we revisit or rebalance our portfolio?
So I would say every 3 years is something we should look at, because every time we design a portfolio, let's assume we start a portfolio today. By the time the portfolio gets built, it'll take us 6 to 9 months to build the portfolio, and give it a 1 to 2 years, 1.5 to 2 years kind of a leeway, and that's where the rebalancing will happen. Should happen. I would say 3 years is the first. Uh, then the first time you should look at the overall asset allocation and then try to rebalance the portfolio. What I've seen is that because incrementally, as like I said, India is going through financialization of assets. In the last 3 4 years, new assets have come in, and incrementally the capital which comes in to deploy to invest, those allocations have gone there. So it takes good 2 to 3 years. I would say 3 to 4 years to actually take that call on whether we should rebalance. So I would say minimum 3 years. It should be is only when you should consider to rebalance the portfolio.
Right. Thank you very much, Vipul. Great talking to you today, and happy Dhanteras, happy Diwali to you and yours from us and ours. Take care.
Thank you so much. Bye bye. Thank you.
Thank you.